380 million XRP moved off exchanges in a single week, and almost nobody watching the price noticed a thing. That's the silent accumulation story nobody's covering, because the chart didn't move while it happened. Here's what actually happened underneath the flat candle. Let's slow down, because the mechanics here matter more than the headline number. Think of exchange reserves as simply the pool of coins sitting on trading platforms ready to be bought or sold at a moment's notice. When that pool shrinks, it means holders are pulling coins off exchanges and into their own custody. The opposite of what you'd expect if people were preparing to sell. XRP exchange reserves just hit a 7-year low. That's not a retail statistic. That's the kind of number tier 1 liquidity providers watch closely because it tells you supply available for immediate sale is drying up. In plain terms, the coins available to sell on short notice just hit their lowest point in 7 years, while large holders kept buying anyway. Here's what that actually means for you as someone trying to figure out who's actually behind this. Most people assume big buyers show up on the public order book, the visible list of buy and sell orders you'd see on any exchange app. They don't. Not at this scale. A single institutional order worth tens of millions of dollars placed directly on a public order book would move the price against itself before the order even filled. That's called slippage, and no serious counterparty accepts that kind of cost. Strip away the institutional language, and here is what is actually happening. Large buyers root around the public order book entirely, using private OTC desks, over-the-counter trading operations that match big buyers and sellers directly, away from public view. Ripple's own institutional distribution rails, along with specialized crypto prime brokers, handle a meaningful share of this flow. It never touches a retail trading screen. That's not a conspiracy. That's just how institutional size trades work in every market, from equities to bonds to commodities. In plain terms, most of what's driving whale accumulation right now happens somewhere retail traders never see it happen. Now let's go into who's actually behind these desks, because institutional buyer is doing a lot of work in most coverage without ever getting specific. Payment service providers and cross-border payment corridors that route transactions through Ripple Payments, the network formerly known as on-demand liquidity, need to actively buy and sell XRP to keep those corridors funded. Think of a payment corridor as a pre-funded pipeline between two currencies where liquidity has to sit ready on both ends before a transaction can settle instantly instead of waiting days for a correspondent bank chain. Every time that corridor scales, someone has to seed more liquidity into it. That's active, ongoing buying that doesn't show up as a single dramatic headline. Here's what most people miss. Crypto asset managers and ETF issuers building structured products, trust funds, and international exchange-traded products also have to continuously rebalance and accumulate spot XRP to back the shares they issue. Most people hear ETF rebalancing and think it's a one-time event. It isn't. It's a continuous mechanical buying obligation tied directly to fund inflows. Put simply, none of these buyers are trying to time the market the way a retail trader does. They're buying because their operational model requires it. There's a second category of buyer worth naming specifically because it rarely gets its own line in retail coverage. Institutional brokerages and large market makers, the firms that provide liquidity and pricing across multiple exchanges simultaneously, hold working inventory of XRP the same way a bank holds working capital in a foreign currency it actively clears. Think of working inventory as simply the stock a business keeps on hand to fill orders quickly, the way a hardware store keeps extra lumber in the back instead of ordering it fresh for every single customer. Ripple Prime, the company's institutional brokerage arm, recently closed an upsized capital raise specifically to expand this kind of institutional-facing infrastructure. Here's what that actually means for you. When a brokerage raises fresh capital specifically to expand institutional service capacity, that's a direct signal about where that firm expects client demand to keep growing, not a speculative bet on price. Most people hear brokerage raises capital and assume it's unrelated to accumulation data. It isn't. Expanded brokerage capacity and expanded OTC accumulation tend to move together because one enables the other. Let's talk about what the on-chain data actually shows, because the numbers back this up in a way that's hard to argue with. Whales, wallets holding 10 million to 100 million plus XRP, accumulated hundreds of millions of tokens over tight multi-day windows this August. More than 38 transactions above $1 million hit the ledger in a single 24-hour window, a 280% surge over baseline. Here is the part they aren't telling you. Average spot order sizes in the big whale tier stayed elevated throughout, which is the signature of sustained accumulation, not short-term retail trading noise. That's not a guess. That's how the ledger is coded. Every transaction above these thresholds is publicly visible and time-stamped. Here's what that actually means for you. High-value transfers off exchanges reflect two different things happening at once, and it's worth knowing the difference. Some of it is genuine spot accumulation, moving into cold storage or multi-signature custody, real buyers taking real coins off the market long term. Some of it is liquidity providers simply rebalancing funds across custodial platforms, which looks identical on chain but isn't new demand. Most people hear whale transfer and assume it's always a buy signal. It isn't always. That distinction is exactly why this channel doesn't just report the number and move on. Now, here's the honest caveat. No hype attached to it either direction, because that's the standard this channel holds itself to. 380 million XRP is a real, meaningful figure. But it's small relative to both the circulating supply and to Ripple's own monthly escrow releases, which regularly return roughly 1 billion tokens to potential circulation. Here's what that actually means for you. If broader market conditions turn sharply negative, escrow releases and smaller holder selling could still overwhelm what whales are accumulating. This data doesn't guarantee a floor. It documents behavior. In plain terms, big holders are buying more than they're selling right now, and that's genuinely bullish positioning. But it's not the same as a guarantee the price can't fall. So here's your systemic defense blueprint, the part you can actually use. Stop watching only the price chart. Track exchange reserve levels alongside it, because a shrinking reserve pool combined with flat or falling price is exactly the divergence pattern that shows up before major structural moves in either direction. When you see a large whale transfer reported, ask whether it's described as moving to cold storage or moving between custodial platforms. Those are structurally different signals wearing the same headline. One more mechanic worth understanding before you close this video, because it explains why this kind of accumulation often precedes visible price action by weeks or months. Order book depth, the total volume of buy and sell orders stacked at different price levels on an exchange, thins out when large holders pull supply into private custody instead of leaving it available for sale. Thinner order book depth means it takes less new buying pressure to move the price meaningfully, because there's less standing supply absorbing that pressure. Here's what that actually means for you. Silent accumulation during a flat or falling price doesn't just reflect confidence from large holders. It mechanically sets up conditions where the next real demand shock, whether from an ETF, a payment quarter scaling, or a shift in sentiment, has less resistance to work against. That's not a prediction of when that happens. It's a structural description of why accumulation phases like this one tend to matter more than they appear to in the moment. That's the silent accumulation story, not a chart pattern. A structural shift in who's holding the supply, happening in places most retail coverage never looks.